In this video, you'll be learning about this topic. So guys, let's focus on valuation. As we've talked about here on the show, you find the intrinsic value of a stock by discounting the cash flows back at an appropriate discount rate back into today's value. Could you please just talk to us about the valuation in real estate and perhaps use a specific example from your previous deals?
So the value of a property is essentially worth, let's divide this up. There are two types of real estate we want to look at. There's residential real estate, which is like a house, right? I buy a single family house. That house is worth what other houses have sold for. That's the best way to say it, right? Like what's an iPhone worth? An iPhone's really worth, has nothing to do with how much it costs Apple to make it. It's worth what the competitors are charging, maybe a little bit more because it's a little nicer, right? And so real estate in terms of residential houses and maybe duplexes and triplexes, 2 and 3 and 4 units, they're all valued that way, what the neighbor's house sold for, the house a mile away sold for. When we get into larger deals like commercial properties, like what I do today, I buy a lot of mobile home parks. I buy big mobile home, we have these, in America, we have these thing called mobile home parks. They're basically like little houses that are cheaply built and you can have 100 or 200, 300 on a property and they're all hooked up to the water. Anyway, people live in these, they're low cost, they're low rent. It's really just affordable housing. And we have a lot of these. So anyway, I buy these. And when you buy big things like apartments and mobile home parks, they're valued based on the profit that they generate. And so there's a thing, I don't want to go too deep into this, but there's cap rate and NOI and all this stuff that we basically, we're asking the question, what type of return would an investor want on this property? If in the area, every investor wants a 5% return, then that property is going to be valued looking at all the income that comes in, all the expenses that go out, what kind of return are they making? It's valued based on that. And they want, what's it worth at 5%? If the average in an area, everyone wants 10% because maybe it's a little bit more risky area, so they would need a higher return, then everything's valued on what would give the investor who buys it a 10% return. Just not to get too far in the weeds here, but when I say that 10% return, that's without leverage. So what would an investor without using a loan, what kind of return would they get on their money every year? And typically in America, between 5 and 6% is pretty normal right now. You can get down to the 3s in some area. You can get up to the 7s in some areas. But typically, I would say 5 to 6 is a pretty normal, what we call cap rate. And again, that's the return. So that's how you kind of value real estate is either the small ones, like the houses are valued on what the neighbor is and what the neighbor sold their house for. The larger deals are based on what the neighboring properties, other commercial properties, what kind of returns they generate. So I bought a house. Actually, this is a true story happening right now. I bought a house 8 years ago for $65,000 because all the houses in the area were going around $65,000, $70,000. And some houses were up in $80,000 and $90,000 because they were all nicer. Some houses were down in like the $20,000 or the $30,000 because they were just dumps that were full of garbage. But pretty average was about $65,000. So I bought it for $65,000. Over the last 8 years now, it has continually gone up because more and more houses are worth more and more money around the area. People, like inflation's carrying it up, more and more people, the supply and demand is playing into it because more people want to buy. And I just talked to my real estate agent yesterday and he says that house now, all the neighboring houses, all the area in the neighborhood, they're all going for over $200,000. So here I am, I bought this property for $65,000. I've been making several $100s a month every month on that property for a long time now. And now it's worth over $200,000, maybe up to $215,000. Why is it worth $215,000? Because a lot of other houses, there's that one that's just like it sold for $220,000. That one is just like it sold for $200,000. That one just like it sold for $205,000. So we can get an idea based on that. That's again, the residential side.
We should probably highlight, if we're being completely honest, Brandon had no idea that would happen when he bought it for $65,000. He knew I'll make X amount of money a month. I'll pay it off. I hope it goes up. If it doesn't, I'm okay. So this isn't necessarily about outsmarting the market. It's really just waiting, and inflation does that work for you. So what he's describing is residential real estate. When you're buying residential real estate, what you do is you try to buy in an area that you think people want to live, because as time goes by and there's increased demand, prices will go up because supply in real estate, you can't just go like an IPO and a bunch of houses pop up. It takes a while for houses to be built. You've squeezed some value out of the long-term hold because you bought in the right area. The other strategy is you look for the messiest, ugliest, worst house in the best area. You buy it and then you make it nicer. So if every other house was selling for $100,000 when he bought it, and he bought this one for $65,000 because it was nasty and ugly and no one wanted to deal with it, he could have created $35,000 in equity right off the bat, which then turned into $200,000. So when you're asking the question of how do you value property, it's actually pretty simple. A lot of people get caught up trying to look at too many numbers and trying to figure out where are migration trends going and what's the hottest thing. But really, if you just continually invest, buy houses in areas where you get a solid tenant and you don't have to worry and you wait, you see stories like Brandon's pretty frequently.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.